Welcome back to Luke's Properties YouTube channel. In this video, I'm going to show you how I refinanced my home to buy another house. Let's get into it. So back in 2020, I bought my first house. I'd had a couple of good years in my rent-to-rent business, and rather than spending the profits on fancy things, nice cars or a nice watch, I decided to use that money to buy my first property. I was living in London at the time, but my rent-to-rent business was based in South Wales. And at first, I was looking in London to try and find my first property, but prices were so expensive and the amount of deposit I'd have to put down just wasn't making sense to me. I wanted to get on the ladder, but I didn't want to invest all of my capital into one house. I wanted to spread my money out a bit, hedge my bets, and at the time, I didn't know loads about buying property, so I wanted to be a bit more reserved, play it safe, and buy somewhere where I could actually afford the property, afford the mortgage if things were to go wrong. So where better to start than where I had built my rent-to-rent business. I had experience with managing other people's properties. I had made money from renting people's properties, giving them a cosmetic refurbishment, furnishing them, and then re-renting them out for a premium. I'd been doing that for at least 2 years. So I had good experience. I had cut my teeth, so to speak, in the property game. I'd worked for landlords and learned from them. So at this point, I felt ready to invest and buy my first property. However, I couldn't afford to buy it in London. So I looked in Wales. So now I'm going to run through the numbers with you and show you how much that cost me. So I found myself a 3-bedroom end terrace property with off-road parking. It was listed for £125,000. I went to view it straight away. I liked it. I got on with the owner well, and I put an offer in of £120,000. A week later, the owner phoned me and said they had another offer of £125,000, but that offer was from a family that were in a chain. What that means is they were waiting to sell their home before they had the money to buy this house. I wasn't in that position. I was ready to move. I had my mortgage agreement in principle. I had my deposit funds ready. I didn't need to sell a home. So the seller chose to go with me for speed and efficiency purposes and the fact that I can move quite quickly compared to their other offer. So I bought the house for £120,000. Now my deposit was 25% of the purchase price. And the reason for this is because I'm self-employed or a business owner. The lenders and the banks class me as self-employed, which they actually see as a higher risk than someone who's on PAYE. Even if I was earning more than someone in a normal job, they still see me as a self-employed businessman as a higher risk than someone that's in a steady 9 to 5. So for that reason, the lender at the time, which I think was Santander, they wanted me to put down 25% rather than the 15% deposit that most people on PAYE get to put down as a first-time buyer, which at the time I found quite inconvenient. But looking back now, it gave me more skin in the game. It gave me more power to negotiate terms. And subconsciously, it kind of forced me to think about this house as an investment rather than my home residence. Because I had 25% in it, I kind of always saw it as a buy-to-let property, which I'll talk about more later on in the video. So my deposit was £30,000. My solicitor fees at the time on a residential purchase were £1,000. My stamp duty, because the property was a first-time purchase, was £0. The house was actually recently renovated when I bought it, so everything was new and modern in the property. But I did spend around £2,000 on furnishing the property, and that brought my total spend to £33,000. Now, when I bought this house, I still had my flat that I rented in London, and I also started a new business around the same sort of time, which was an information education business. I was back and forth from Wales to London quite often, and although my plan originally was to live in that house, things started to change. So I contacted my mortgage lender and I told them about the situation. I told them how my plans had changed, and I asked them for consent to let, which they granted me. I think I had to pay a couple £100 for that, but what that allowed me to do was then rent the property out for an income. So let me run through those numbers with you. So I rented the property out as a furnished property with all the bills included for £1,200 per month. My mortgage at the time was on a really low interest rate of around 1.8%. It was a repayment mortgage, but my payment was still very low at £326 per month. Then I had to deduct my bills, which was my gas, electric, water. I put Wi-Fi in the property as well. And obviously I had to pay council tax. So those bills came to £330. My next cost was my insurance, my landlord insurance, which cost me £30. And then I'd always put aside around £50 per month for minor maintenance. So after all of those costs, That gave me a net income of £464 per month, or £5,568 per year. Now, when I take that £5,568 and I divide it by my total capital employed, which was £33,000, and then I multiply that figure by 100, that gives me a return on capital employed of 16.8%. So in other words, I'm getting 16.8% back from the capital that I employed initially into the property from the rental income. Now, most investors would be happy with a 10% return from their capital employed in any other investment. So at 16.8%, I knew I was onto a winner. And that's not considering capital appreciation, that's solely from the rental income. So moving on to 2024, house prices increased substantially over that 4-year period. So by 2024, the house was valued at £150,000. That meant that my equity had increased from £30,000 to £60,000. And the rent that I had received over those 4 years was £22,272. Obviously, you have to pay tax on that income, and as a basic rate taxpayer at 20%, that gave me a post-tax rental income of £17,817. So at this point, I felt it was a good time to refinance the property. I'd done the numbers, and although interest rates had increased since I first bought the house back in 2020, rents had increased too. And because I had consent to let, I'd done the numbers and I worked out I could still make a very good return on my capital if I got a new mortgage against the property, with the plan of paying off the old mortgage, having some excess money left over, and then using that excess money to go and buy another house. When I'd done the numbers, I realized that by buying another house, that house would outwork the new debt that I took on. As long as I made sure it was in a good rental area and I was going to get at least a 10% return from the rental income per year, and judging off of how my first house had appreciated, I felt quite confident about the second house increasing in value by around 5% per year. So when I add the 5% to the 10% that the rental income generates, that gives me a 15% return on my capital employed annually. And the new mortgage that I took out was at around 5% interest. So if the houses I buy are giving me a 15% return on my capital employed per year, and my debt is 5% per year, then that means I'm going to net 10%. And by buying these houses, I'm getting to grow my net worth. The bank funds 75% of the asset, and I get to benefit from 100% of the appreciation. So to me, at this point, it was a no-brainer. So I decided to refinance the house to the new value. So my new mortgage was £112,500. My old mortgage was £85,000. So I used the new mortgage to pay off the old mortgage. I also had to pay some fees to my mortgage broker and a product fee for the new loan. So my fees added up to £2,500, which left me with £25,000 in tax-free money. Now, when I add this tax-free money to my post-tax rental income that I've received over those 4 years, I get £42,817. And considering I only put £33,000 into the house initially, 4 years prior, that means I've made all of my initial capital back, plus around £10,000. So at this point, I've actually been paid £10,000 to own this house. So what I'm going to do with this £42,817 is, of course, buy another house and repeat the process. Now, house prices are set to rise by 26.4% over the next 4 years, leading to 2028. And don't just take my word for it. This is data from Savills' most recent house price forecast, so go and have a look at that yourself. So let's have a look at those numbers, and I'll show you what my expected returns will be and what my plan is over the next 4 years. So by 2028, the house price will be worth around £190,000. At that point, my equity will be £77,500. So even though this year I've got all of my initial capital back out of the house, I still have 25% of my own equity in the house. And by 2028, that equity would have grown to £77,500. Again, the rent that I would have received will be around £22,272. And after tax, that works out to be around £17,817. And that's not taking into consideration the fact that rents will increase, as they have done over the past 4 years, by around 5% per year. We're being quite reserved with these rental income figures, and we're basing those figures on the scenario that I have the same tenants in the house over that period. Now, obviously, there will be a week here or there where I don't have any tenants, maybe even 2 weeks here or there. But because rents will increase over that period of time, the rental increase will cover that void period where I might be in between tenancies. So let's just work off of this figure for now and keep it reserved just to manage your expectations. So let's say I make £17,817 over those next 4 years from the rental income. Well, if my equity's grown to £77,500, that's a large percentage of the house price. And I don't personally want to have that much equity in the house, as my plan isn't to pay off my mortgage. My plan is to grow and scale my net worth aggressively while I'm still young enough and have enough energy to do so. So I'm constantly trying to buy more houses because I know the more assets I own, the more wealthy I'll become and the more passive income I get to benefit from, which gives me time and location freedom. And that's why I'm in this game, to have total freedom and autonomy over my time. That's why I started my rent to rent business 7 years ago. It was to get to this stage now where I'm buying houses and growing and scaling my net worth. So by 2028, this will be another good time to refinance the house. So again, you know how this works. We're rinsing and repeating this strategy here. My new mortgage based on the new value will be £142,500. I'll use that to pay off the old mortgage, which will be at around £107,500. And that will leave me with around £30,000 after my fees in tax-free money. And you know what happens next. I'm going to use this tax-free money, put it with my post-tax rental income. That's going to give me around £47,000 to £48,000, which I'm then going to use to go and buy another house. This is how wealthy people intelligently leverage debt to grow and scale their net worth. If you want to see another video like this about how I bought a house for £95,000, then watch this video next. I hope you've enjoyed this video. If you have, please remember to like and subscribe and feel free to comment so we can continue the conversation. And as always, I'll see you on the next one.